Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. I'm excited to announce our upcoming schedule of the Planet MicroCap Showcases, our investor conferences showcasing the microcap community. We will be hosting the Planet MicroCap Showcase virtual on December 6th through 8th, 2022, and we'll be back in Las Vegas for our in-person event on April 25 through 27, 2023. Attendance for both events are complimentary for investors, so expect to interact with microcap management teams, hear insightful keynotes and panels, plus network with your fellow microcap crew. Registration is now open for our virtual event, so to join us, please visit www.planetmicrocapshowcase.com. Now, for this episode of the Planet MicroCap Podcast, I welcomed back Gautam Baid, founder and managing partner at Stellar Wealth Partners, LLC. In our last interaction, we discussed his background, journey to the US, his book, The Joys of Compounding, and his stint as portfolio manager at Summit Global Investments. After leaving Summit Global in July last year, where Gautam was a portfolio manager for the last 5 years, he set out to start his own fund focused on Indian equities. In our discussion, we talk about Gautam's new endeavor at Stellar Wealth Partners, why Indian listed equities only, why U.S. investors looking to get exposure outside the U.S. should consider India, understanding the Indian economy and growth prospects, plus why now is the time to get exposure to Indian equities. Thank you again for tuning in to episode 244 of the Planet MicroCap Podcast, and please enjoy my conversation with Gautam Baid. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Gautam, thank you so much for joining me again. Great to see you, and thank you for being here.
Thank you, Robert. This should be fun.
Absolutely. Look, you've been busy. We were just talking offline. Look, it's been a couple of years since we last talked, and we're all busy. Everything's going on, but you've been busy. So, last time we chatted, we were talking about your background and how you got to where you are today, writing the book, of course, The Joys of Compounding. But now you're on this whole new path where you're now the managing partner and fund manager at Stellar Wealth Partners India Fund. So catch us up from the last 2 years. What's been going on?
So as I worked at Summit Global Investments in Salt Lake City for 5 years as a portfolio manager of global equity strategy. And while tracking the global stock markets as portfolio manager, India as a stock market very clearly stood out to me in terms of the number of high growth opportunities which it offered, So last year in July, I quit my job and I ventured out on getting all the regulatory approvals for setting up this fund. And in the last few months, I've been busy meeting investors and raising capital. We'll be going live with the fund next month on 3rd of October, Monday. And it has been a pretty intriguing and a very fruitful journey so far. And I'm very excited to bring the India investment opportunity to investors in America, because after the crash in the Nasdaq and all the technology stocks in the last 10 months, many investors in America are now realizing that they were just merely the beneficiaries of all this cheap money printing by the Federal Reserve over the last 13 years, which made investors bid the stocks of many unprofitable, loss-making technology stocks up. It was, I would say, more of luck than skill. But India is a market where hardcore fundamentals matter. People look at balance sheets, profits, cash flows, capital allocation, management quality, size of the opportunity. In India, unless you focus on hardcore fundamentals, the good old investing as we call it, you won't be able to succeed. And in America, a lot of investors were focusing more on top line and revenue growth without actually understanding the unit economics of the underlying business. So I'm more of a traditional investor. Even in my American stock portfolio, I own shares like Microsoft and Google, all companies with a lot of cash on their balance sheet, very profitable, large runway for growth. So that is the kind of companies I like to invest in. But those kind of profitable cash flow generative businesses growing at a high clip is very limited in America. But in India, you get a lot of such opportunities. In India, you have more than 6,000 listed companies. And so the pool of opportunities is very, very large. And outside the US, in the world today, India is the only market of large scale and size, which offers very high growth to investors as well. And this is also being demonstrated by the activities of the investors in the last few months. Just in the previous month of August, out of the total emerging market inflows of $7.5 billion, India attracted almost 80% of that alone. In spite of being a very tiny percentage of the emerging market index, very few people know that China and Taiwan make up almost 50% of the emerging market index, while India is at a small, tiny percentage. But in spite of having a small allocation in the emerging market basket, India attracted 80% of the overall emerging market flows last month. Why did that happen? It's because of the geopolitical tensions between China and Taiwan. And as investors pull money out of those two nations, so basically out of 50% of the emerging market basket, money is being pulled out to more stable countries with democracies and rule of law like India.
Absolutely. Okay. So lots of different rabbit holes to go down there right now. Obviously one of my questions was going to be, the India fund, talk to me about that. But what's been in starting to market the fund and getting out there and spreading the word, doing interviews like this, what's been some of the feedback that you get from US investors? Like, I'm assuming that they're from Texas, India, like what's going on there? What's been some of the feedback?
The common thing which I notice in most investors in US is what is known as a home country bias. So it's also connected with something called familiarity bias. So home country bias and familiarity bias. So once you become familiar and comfortable with investing in your home country, generally most investors are very hesitant to invest outside their jurisdiction to a foreign nation, especially among an emerging market. But when I pitched my fund to investors, I tell them, don't treat this India fund like your core investment. Treat this more for the diversification benefits. So just consider this more for the diversification benefits which you'll get. Just to give you an example, in the last 10 months, the Nasdaq is down more than 30%, but the Indian benchmark index is up 4%. So a 34% outperformance in just 10 months. Now, again, some people may say this is just a recency bias, but it just tells you the benefits of diversification. Diversification seems not that appealing until it does. And it is during periods of such a turmoil in a particular country that you realize the benefits of international diversification. And that is where this India fund will fit into the picture for most investors. This is the first thing. The second thing, which many people ask, is how am I able to evaluate the management quality of companies in India while living and working in the US? And for that, I follow a comprehensive corporate governance checklist, which I take them through when I give them one-on-one fund presentations. There's a long list of checklist items on that corporate governance checklist, which I go through for each company. And that's why out of the more than 6,000 listed companies in India, in my view, barely 50 or 60 are just suitable for true long-term investing. So the key to succeed in the Indian market is not to take undue risk. India is not a market to take risk in. You want to basically crush risk from multiple angles in a emerging market. So you want to crush government risk, regulatory risk, political risk, business industry risk, management risk. There are many risks. You want to just crush risk from as many angles as possible to arrive at the final portfolio of very high quality businesses. And just like the US market, there are very few of them in the Indian market as well. That is the area where a fund manager needs to focus his attention on to create long-term wealth. Because after every bear market, the companies with bad corporate governance, those stocks get hammered completely and they never recover. But the truly high quality businesses always recover back the fastest after every bear market crash. So it's not about making paper profit or paper money. It's also about retaining that wealth through the future bear markets.
Absolutely. I mean, Gautam, I also have to ask, before, we'll get into even some more nitty gritty here, but I mean, was this always a dream for you when you got your career started in finance that, hey, I wanted to do something or have a fund that's covering India, and now was the opportunity to really do that? Growing up in India from here, having immigrated to the US, love to hear if that was the case.
When I came to the US, that time my sole focus, I came to the US in 2015. That time my sole focus was simply to get on the stock market side. I was very passionate about investing, so I wanted to get on the buy side. And many people know about my initial days of struggle here. It took time, but that's how compounding works. Compounding will bestow its magic and benefits upon you only after testing your patience and conviction to the fullest. But I never thought I'll land up in the role of a portfolio manager. I thought I'll probably start off as a junior analyst, then graduate to analyst, then senior analyst, then assistant portfolio manager, and then probably portfolio manager in 12 to 14 years. But I straight away landed that kind of a role. So God has been very kind, and I consider myself very fortunate. And I was very happy in that particular job. I was tracking global stock markets, getting paid to read and learn every day and improve every day. But the heart, soul, and passion always lied with India, because that is where I've created more than 80 to 90% of my personal wealth. So I've been investing in the Indian stock markets for the last 15 years. And I've done pretty well for myself. I achieved financial independence through investing in the Indian stock market. I mean, that is the reason why I could afford to quit such a high-paying job as a portfolio manager last year. Because beyond a certain point of wealth and time in life, you basically realize that you just have this one short life to live. So why not do something that you're truly passionate about? So that is the reason why I decided to set up this India fund.
Very cool. And also, listen, if anybody missed our first interview together, please go check it out. Gautam's story is really amazing. Or go read the book, The Joys of Compounding. It's really a fantastic read, and just so many great insights and nuggets that, you just always want to come back to. So I wanted to get into the fee structure for the fund, because when you go on the website, the first thing you see is like Buffett fee structure partnership fund. Like, I wanted to do the exact same way. No performance fee. I think it's if you perform at a minimum 6%, then you get the. So tell us a little bit about why you wanted to set up the fund this way, other than the fact that you are a Buffett neophyte, of course.
So Robert, trust is earned when actions meet words. And in my book, I've written a chapter which is called Living Life as per the UNESCO card, in which I've talked about the original Buffett partnership fee structure and how Buffett in his partnership years used to demonstrate certain attributes like authenticity, sincerity, integrity, honesty. And it's just not enough for me to talk about these things and preach about these things. It's also important for me to put this into action. And you will rarely find such an equitable fee structure in the hedge fund industry today, like the original Buffett partnership structure. Buffett used to charge zero management fees, and he used to charge a 25% profit share on gains over 6% per annum, subject to a high watermark provision. And even this hurdle rate of 6% was cumulative in nature. So many hedge funds in this country have got a non-cumulative hurdle rate. What does that mean? It means that suppose you start with 100 and suppose your value goes down to 94 at the end of year one. For most hedge funds in the second year, the hurdle rate is 6% of 94. But in my fund, because I've kept a cumulative hurdle rate, at the end of year two, if my fund value falls to 94 at the end of year one, I need to make 18% in year two just to get back to 106 plus 6%. So it's a cumulative hurdle rate, which is very, very demanding. And it is also subject to a high watermark provision. What does that mean? A high watermark provision means that unless the client's annual year-ending value crosses the previous all-time high on a yearly closing basis, and the client has also earned a 6% return per annum in dollar terms, till that time the fund manager, that is me, I don't get paid a single penny. So you may have a situation that over the next 5 years, the fund earns 6% returns per annum, but I end up making zero. Basically, I end up working for all the clients for free, and that's perfectly acceptable with me. In fact, what I've told my initial investors is that if I cannot deliver you even 6% returns in dollar terms for the first 5 years, then you should actually take out your money and put it elsewhere, because why should you waste your time any longer? So you just don't. And anyways, I don't have any incentive to raise AUM, because there is zero management fees, right? So unlike most hedge fund managers who do not have any downside because they're getting paid hefty management fees, in my case, because I'm being paid only and only on performance and great performance. So in my case, there is no incentive for me to raise a large amount of AUM. Also, because I'm putting a significant portion of my personal liquid net worth into this India fund to have skin in the game, the clients can sleep peacefully at night, knowing that the fund manager Gautam is also is going to be very prudent and very conservative, because he has got his own money on the line. Most hedge fund managers don't put a single penny of their own personal capital into their fund. They just charge management fees and they become rich. But what about the clients? When I was setting up this fund, I was constantly asking myself, if I was an outside investor, what would I love to see in the fund? I would love to see a frugal operating cost structure. I would love to see zero management fees. I would like to see a cumulative hurdle rate. I would love to see the fund manager having large skin in the game, and also for the fund manager to be very tax efficient in nature by having a long-term horizon. So these 5 attributes I would definitely love to see. Plus, I would also love to see that the fund, like every hedge fund, has got a team of service providers. I would love to see that all the service providers have had prior extensive experience of dealing with India-focused funds. And I would also look at the fund's auditor, because every hedge fund, I normally has an annual audit, and you don't want to skimp on that particular aspect, because when you're meeting investors, when you talk about your auditor, in our case, Stellar Wealth Partners India Fund's auditor is Spicer Jeffries. They are the leading name in the hedge fund industry. So these small things, if you just take care of these small things, then you can go a long way. And like I've written in my book as well, for me, sleeping well is equally important as eating well. So I want my clients and myself to sleep peacefully at night. And for that, I want to focus on delivering a positive emotional return to them as well, in addition to the financial return. Most fund managers will focus only on the financial part. But for me, what does delivering a positive emotional return mean? It means I should be readily accessible and available for all the limited partners all the time. I should be able to handhold them during future bear markets and market crashes, educate them on what's happening on the portfolio's prospects, have a Zoom webinar with all the clients together, or have one-on-one discussions with them, write my semi-annual investor letters, keep them updated on what's happening. Just these small softer attributes will go a long way, because money management business at the end of the day, it's a relationship management business. You have to look at each partner as a long-term relationship, and
100%.
Really solidifying that.
Yeah, absolutely. Look, whether I invest in the fund or not, I just want to make sure that I'm on the mailing list, because I have a feeling these quarterly letters are going to be some of the more well-written ones. Most of them are very well written, but I'm definitely, we're a published author. I want to read yours. So let's talk about the portfolio construction. How concentrated, how diversified. Love to hear everything there.
So the portfolio will comprise of around 20 to 30 stocks. And the logic for this number is, so as per a study published in the international bestseller, A Random Walk Down Wall Street, it was demonstrated that as the number of stocks in a portfolio reaches 25 to 30 names, you have captured almost all of the benefits of diversification, yet the number of companies you need to know thoroughly is still manageable. And this is a very sweet spot for me. I'll be initially starting with 26 names in the portfolio. And this is an allocation. Basically, in each stock, we'll start with an initial allocation of 3 to 5%. And for the occasional exceptional opportunities, we may go up to even 10% on a single name in the very beginning. But prudence will always be maintained at all times. What do I mean by this? This is very important. So let me explain this. So I will let my winners run, but I will not let a single stock become more than 20% of the overall portfolio by value, because I do not want a single promoter or management team to determine the life outcomes for myself or my investors. So you have to ensure that you're not overly exposed to factor risk. Even in the very beginning, the portfolio is diversified across 13 different industries. One of the key reasons why many hedge funds in US blew up in the last 6 months is because they were overly exposed 100% to one single factor, technology. But again, I like to learn from case studies of extreme failure and extreme success. I've understood that the key to compounding is time and endurance. If I can survive for the next 20, 30 years along with my partners, we'll all become rich just by the sheer tailwind of India's growth and the power of intrinsic compounding in companies. So the key is to survive. Like Peter Bernstein has very rightly said, survival is the only road to riches. I want to survive for the long term, and for that, you have to avoid ruin, avoid the risk of ruin, and for that, avoid factor risk. The only single factor risk in our case is basically being exposed to one single country, India. But India has got an exemplary track record of letting foreign investors enter and exit at will, no questions asked. I mean, just to give you a number, in the last 10 months, foreign investors have withdrawn more than $20 billion net out of India. And still the Indian market is up 4% this year, January to today, as opposed to the Nasdaq, which is down 30%. How is that possible? It's because of the rise of the domestic investor in India. So if you look at what happened in China, Chinese markets as well over the last 20 years, a lot of the activity was driven by the domestic investors. Same thing is happening in India now. As the penetration of equities as an asset class keeps going up with rising penetration of smartphones and awareness among the Indian public, the domestic investor is coming to the fore and the foreign investors are becoming less relevant in driving the benchmark indices in India. So that is a natural tailwind which we'll enjoy for the next many years.
Absolutely. So in terms of the size of the companies that you're looking at, look, we're a microcap show. I'd be remiss if I didn't ask if there was any potential exposure to microcaps amongst the, initial 26 and, between the 20 and 30 in the future. Do you have any constraints on size of companies, or can you look at across the board?
So the fund will not have any micro caps in the beginning. There's a reason for the reason for that is the trading volume constraint. So even if, like when you go through my website, you'll see that I've decided to hard close the fund to new and existing investors at just 50 million of AUM. So you can clearly make out the reason why. It's because this fund will have a lot of exposure to small cap stocks in India, and because I've got my own money on the line, obviously it aligns my interest with that of my partners to focus on maximizing returns. At the same time, because my own money is on the line, I'll focus on downside risk as well. But the small cap stocks in India are pretty illiquid. So that's the reason why I've decided to just keep the fund small and light so that I can keep investing in the high growth, smaller companies in India. In India, the micro cap stocks which you're referring to are basically all the companies which are below 50 million of market cap, 50 million USD in market cap. Those are the ones we consider micro caps. But the trading volumes in those are just negligible. They're just literally non-existent, and that's why even though I would love to invest in such companies, but given the size of the fund, just to give you a number, so suppose we hard close the fund at 50 million of AUM, to establish a 3% position means I have to buy stocks worth 1.5 million micro cap. And out of the in India, what happens is the insiders, the management, the owners of the company, they have a large insider ownership in the companies. The ownership ranges from 60 to 75% in most companies. So just do some simple math. A 50 million market cap company, out of which 75% is held by the insiders. So the total free float available is 25% of 50 million, which is 12.5 million in total. So to acquire shares worth 1.5 million out of the 12.5 million of free float, it's going to be a very tall ask. It'll take a month or more to accumulate that kind of a position.
100%. Yeah.
I have to go to the small cap stage and above. I cannot go to the micro cap stage.
So how does India on the exchange? How do you guys demarket? Because in the US, like we define microcaps, 300 million of 50 to 300 million market cap US, and then nano cap 50 million or less, and then above 300 to like 2 billion. I think it's like small cap, and then 2 billion above. Go from there. So how does it define? You kind of went a little bit there.
So the stock exchanges the stock market regulator in India has actually laid down the criteria for categorizing companies into large cap, mid cap, and small cap. So the first 100 to 150 companies are categorized as large cap, the next 150 as mid cap, and these remaining as small cap. So that's how they define, but they don't have a formal definition for micro cap. This is just based on my experience that because the market cap has also gone up over time. So I define micro caps as anything less than 50 million of 50 million USD market cap. So that's a micro cap for me. So and those are the stocks which I can buy for my personal account, but I cannot buy for the fund. And here I would like to add a very important point, Robert, that managing a personal portfolio is very, very different from managing a public fund. Why is that? Because when you're managing a public fund, the two most important attributes you have to look at is quality and liquidity. Liquidity means average traded daily volume. So in a personal account, you can actually enter and exit very easily. But when you're managing a public fund, and that too, which becomes larger over time, you have to take into consideration the liquidity, because you may face some redemption pressure in the future. Some people may want to redeem, and that is the time when the impact cost of selling these micro caps can be very, very large. So that's why you want to ideally look for stocks which are having a bit more higher trading volume. And I think the more the trading volume, the more it basically means that the stock has been discovered more. The trick is to buy them at a small market cap stage. You can still end up making a very large amount of returns because of the long runway for growth.
Absolutely. Oh yeah. I mean, that's what we preach on here as well, is, you want to find them before the institutions do. That's ultimately the goal. But so I also want to talk about competitive landscape a little bit. Obviously I'm sure, I don't know, I'm sure there's an ETF out there that follows India. But I mean, is there any other US based India focused only funds right now, or is this one of the first?
So there are a handful of them. Malabar Investments is one. Then there is a few others, but they are not that much prominent because there are just so few of them in this country, and that's why I'm very excited to bring this opportunity to the investors here. I believe as India keeps gaining prominence over the coming decade, you'll see many more India focused funds getting established in the US, because many people are now realizing there is a big need to diversify out of the US into other high growth markets, and that is where India will come into the picture. I mean, just look at outside the US, just look at the world, what's happening outside the US. Europe is in a big mess. China has become uninvestable. Taiwan is in the middle of geopolitical tensions. Japan is facing the problem of aging demographic. South Africa, Brazil are having their own set of problems. So which is the only single market of scale and size outside the US which can offer you growth? And the world is made up of capitalists. If you can show growth, then money will basically come from anywhere in the world. So that's why India is attracting so much of the emerging market inflows, because now foreign investors are realizing that, hey, this is a market which is the most stable, which has got favorable demographics. In fact, 65% of India's population is below 35 years of age. And here I would like to add a very important point. We know that the long-term drivers of GDP growth in any country are only two: estimated change in the working age population and productivity growth. And apart from over the next 30 years, as per a study published by Collaborative Fund Research, so apart from Nigeria, which is a small country, and apart from US, which will keep benefiting from favorable immigration trends, India is the only country of scale and size which will experience a 20% increase in its working age population over the next 30 years. But on the other hand, you'll have many large economies like South Korea, Russia, Italy, France, and UK. They'll all experience the same problem which Japan has been facing for the last 30 years, which is that of an aging population. This is where the India long-term story gains further credence. So one more very big point I would like to point out here. So I'm a very avid student of financial market history. So history teaches us that whenever any country transitions from 2.5 trillion of GDP to 5 trillion of GDP, that country's stock market experiences the fastest pace of wealth creation. You look at US, Japan, and China. Whenever those economies doubled from 2.5 trillion to 5 trillion, their stock markets did not just double. Their stock markets tripled and quadrupled and even more. And why did that happen? It's because as a nation transitions from a low income per capita country to a middle income per capita country, the basic spending on items like food does not go up much, but the spending on branded discretionary consumption and financialization of savings, these two categories simply explode. So this is the exponential opportunity which India offers to investors in the world today. Linear growth in GDP, but exponential opportunities in these two categories. And here I would like to add one more very important point, that it took India almost 60 years to reach its first $1 trillion of GDP, but it took India just 7 years to reach the second $1 trillion of GDP. And over the coming decade, as trillions of dollars get added to India's GDP, if we simply assume the market cap to GDP to approximate 1 over time, also known as the Buffett indicator, one can just envisage the kind of wealth creation that lies in store for investors and in great Indian businesses. Trillions of dollars. We're talking trillions of dollars here, right, of market cap addition. And who will capture the bulk of this upcoming wealth creation boom in the Indian stock market? The nation's best managed businesses with proven ability to scale up their operations. It's known as the power law. So, as per a study published by Professor Bidenberg of the University of Arizona, between 1926 and 2016, over those 90 years in America, just 4% of the listed stocks accounted for 100% of the market cap addition. Same thing will happen in India as well. Those handful of companies, the great businesses, will capture the bulk of this upcoming wealth creation boom. So, this, in a nutshell, is the big investment thesis for India.
Absolutely. But I also want to now, let's play devil's advocate, right? You made the thesis abundantly clear, right? In every single way. What are maybe the headwinds, or how does this thesis potentially fail?
Well, I think the political regimes and the political parties and political regimes in India keep changing. And that is why, again, I avoid government facing businesses, because what happens so India goes to a national general election once every 5 years. And what happens is that, you have some cases of crony capitalism, wherein some corporate groups or some companies are basically in close ties with the government. So they get to benefit from the favorable government treatment for them. But if the political dispensation changes after 5 years, then those stocks are very vulnerable. And this is why at all points of time, I avoid government facing companies, and I also check whether the promoter or the management has any political affiliations. So that is the way I avoid that particular risk. So you want to avoid that particular risk. There's one more big risk on the horizon, which I would like to share here, which will impact all stock markets in the world. And that's a potential World War III situation, with China and Russia on one side and the developed countries on the other side. If China invades Taiwan, it seems like a very remote possibility. But with the recent geopolitical developments between China and Taiwan, I just feel the probability, and this is all about probabilities at the end of the day, the probabilities of such an escalation is increasing day by day. So that's one risk which will impact all global stock markets, not just India. So if that happens, then no amount of fundamental analysis will be able to save you. Everything will fall at the same time. But the only defense, in my view, in a world which is interspersed with black swans and uncertainties, is to invest in the world's fastest growing economy, which is India, and have a portfolio of the best and durable business models of that country, and with managements which have a growth DNA. That's the best way which I feel I can defend myself against future uncertainties. That's my best bet. I'm just trying to maximize the odds on my side. That's all I can.
Very good. Listen, we have to get both sides, right? We want to make sure everyone hears the full picture. All right. So when we're looking at the companies that are in the portfolio, do you differentiate, or do you have a preference for companies that just sell whatever it is they're selling, goods, products, services, specifically in India, or do you prefer companies that are more international, maybe have some India exposure, but or some combination of both? Love to hear your thoughts there.
Great question. And again, the preference will always be for domestic facing businesses which are catering to the Indian consumer. Just look at the size of opportunity here. India has got a population of 1.4 billion people. 20% of the entire world's population lives in India. So just imagine the size of the opportunity which you have for companies which provide aspirational yet affordable products. That is the sweet spot. Aspirational yet affordable. And also the luxury and branded goods companies, even those have a long runway for growth. Because again, I love talking with numbers. Let me talk some more numbers here. The global GDP today is approximately $100 trillion. Okay. And the global population today is around 7 billion people, which means you have a global per capita GDP average of $14,500 per person in the world. Okay. But what is the per capita GDP of India today per person? It's just $2,000. Now, obviously, it's a very reasonable expectation that over the next decade or two, India per capita GDP will at least converge to the world average at least. So just by sheer convergence to the world average, you have a 7x jump in the per capita. Just that jump from $2,000 per capita GDP to the global average of $14,500 per capita GDP, just that catching up will do the job for you over the next 20 years. So that's why you ideally want to focus on domestic facing businesses, especially given the increasing global uncertainties. And in case you want to invest in a business in India which is exporting outside the India and to the world, you want to find companies which are globally the most cost efficient and which are global leaders. Even if you invest in a company which is exporting outside India, look for global leadership, especially global cost leadership, because low cost manufacturing and low cost labor is in India's DNA, and that is where India has got a distinct advantage.
Absolutely. So another rabbit hole I want to go down is, the idea of management. You as you said at the beginning, that's a very important part of your research process, very important part of any kind of qualitative due diligence, no matter what size the company is. So let's dive into that a little bit more, where you've gotten some of that feedback from US folks or others that you're based in the US. How, don't you need to have boots on the ground or be in India in order to make sure, you can talk with management at any time? So, let's dive into that a little bit more. How are you mitigating that potential risk?
So it's a two-part answer. I'll give you the first part first. So first of all, after investing in a particular local market or a local country for more than 15 years and building a strong network of contacts in that country, over those 15 years, you develop a very strong sense of which companies are run by fraudulent management teams or bad management teams, and which are considered to be the ethical promoter groups and ethical management teams. So that's the natural advantage which investing over a long period of time gives you. That's the first point. The second and more important point, which I like to emphasize here, is I follow a comprehensive corporate governance checklist when I'm evaluating the management quality of companies in India. So what are the various items in that checklist? I'll share a few of them with you right now. I check for any frequent changes in auditors. Are there any abnormal auditor fees? Is the auditor fees growing faster than revenue growth? Does the company have a long list of unaudited foreign subsidiaries with it? Does the promoter have any political affiliations or criminal proceedings against him? Has the company been subject to any debarments by the capital market regulator? Has the company been subjected to any enforcement directorate, Central Bureau of Investigation, or Income Tax Department raids in the past? Is the company taking loans from the management team at an above market interest rate? Also check if the related party transactions are very significant in size. Check whether the company has shared wealth with shareholders in the past through dividends and share buybacks. Check if the promoter is having a similar business as the listed entity in his privately held company, because that may lead to a conflict of interest. Also, you evaluate accounting quality. In that, check for volatility in depreciation rate, because the depreciation policy can be modified by the management to manipulate earnings. Also check whether the company is writing off expenses against reserves and surpluses on the balance sheet instead of routing it through the income statement, thus inflating profit. Check for the trends in the cash flow from operations to net income ratio, because this will tell you how much of the reported profits are being converted into cash for funding your investment and financing activity. Check for what are the views of the reputed investors and the industry experts about this particular company. Check what are the current employees and ex-employees saying about the company on websites like Glassdoor.com. Check if there is any high contingent liabilities of the company, or if there is any off-balance sheet obligation. For example, has the company given a guarantee for the debt of its other listed group entities? So there's a long list of things to check when you're evaluating management quality, but these are just a few of them. So, and I think at the end of the day, as investors, there are only two things that we can control: our research process, our diligence, basically, and our personal behavior after we have bought the stock. That's the only two things that we can control, right? So our research and our behavior, those are the only two things in our control. And at the end of the day, I should have the personal satisfaction that I did a thorough job. One of the reasons why for launching the fund in the first business day of October and not before that was because in India, the financial year runs from 1st April to 31st March. In America, we have from 1st January to 31st December, but in India, it's from 1st April to 31st March. And the listed companies in India release their annual reports in July, August, September. So just yesterday, I finished reading the annual report of the 26th and final company in the India Fund portfolio. I wanted to be very, very thorough and complete in my research. I wanted to read the annual reports of my shortlisted holdings because I want to understand the guidance and the outlook and the future plans of the managements, which they share in the annual report. And now I have got the satisfaction that okay, I have completed my research thoroughly. Now I can go ahead and invest the money in these stocks.
Very good. I have another question for you because, we're, like I said, we're in microcaps, and there's a lot of companies that may have listed in Canada, Australia, London, all over the world that are now cross-traded in the US, whether they go on NASDAQ, NYSE, or OTC markets. You don't see a lot from Indian companies doing that. Do you have any insight as to why?
I don't know the reason why, to be honest. Only a few handful of, I think 10, 12 large cap companies from India have listed themselves on the NASDAQ and the NYSE here. But the microcaps generally, they are pretty content to remain listed on the Indian exchanges. I think they find more than enough demand. If they're really good, their stocks find enough demand in India itself. So I think that's why they don't really venture out until they become of a bigger size.
Got it. I was just curious. I didn't know if there was any particular reason, or if they're looking for, yeah, I was just curious. All right. So I think we're getting pretty close here. So in terms of actually participating with you and saying, hey, all right, I liked everything that I saw here, what are the next steps, and when's the official launch? Give us some of the details there.
So the fund goes live on 3rd of October, Monday, and we are still accepting subscriptions. We'll keep accepting subscriptions until the time the fund does not reach 50 million of AUM. So every time a new investor comes in, his funds will be deployed on the first business day of the following month. So if any investor transfers his money to the fund's bank account in October, for example, then the funds will get deployed on 1st of November or the first business day of November. So it's a very simple process flow. First, I have an introduction call with the investor one-on-one to understand his attitude towards short-term volatility and his time horizon. And then I give them a formal presentation over Zoom which lasts for 1.5 hours. I talk about my investment philosophy, take them through my investing framework with the help of case studies from the Indian market. I talk about the fund structure, etc. And then at the end of the presentation, I also share with them a detailed Excel spreadsheet in which I start off with the gross Indian currency return, the local rupee return in India, of expected return for the portfolio, which is what I'm expecting. From that, I subtract the expected rupee depreciation, because see, it's very misleading for me to talk about foreign currency returns, because ultimately for investors in US, what matters is the dollar return. How much are you making in dollars after the Indian currency depreciation? So first I subtract the rupee depreciation to arrive at the gross dollar return. From that, I further subtract the operating costs of the fund, the expected performance allocation or the profit share of the fund manager. I also subtract the expected capital gains taxes, both long-term, short-term, from that, to finally arrive at a net number in dollar terms after fees, costs, expenses, and taxes. Because if I can be more transparent and very detailed upfront with investors, that if I set the right expectations from the beginning, then if that investor joins me after that, that is the right investor which I want in the fund. That is the true class of investors which will truly be there for the long term, because they already have the expectations set clearly. They know what to expect for themselves after everything. But most people here talk about gross returns and pre-fees, pre-expenses, pre-taxes returns. That is misleading. That's mis-selling. If you establish trust in the very beginning, and if you have a tendency to under-promise and over-deliver, I think that's the base for a much more fruitful and a happy long-term relationship, be it in a marriage or be it in a business.
Absolutely. So, by the way, how's the process been? It's been quite an environment to now launch the fund and go out and raise capital. Hopefully it's been going well.
Going smoothly, I think. But the only thing is, I've had to say no to around 5 to 6 investors so far in the first 2 months of marketing the fund, because they were just asking all the wrong questions. For example, one of them was asking, how much can I expect in the next 1 year? And the other guy said, I want to invest in this fund because I want to fund my children's college education after 2 years. Those are not the investors you want into the fund. You ideally want long-term patient capital. I tell them, unless you have a horizon of more than 10 years, please do not consider this fund, because the power of compounding is backloaded, and the key to compounding is time. You want to ideally invest for 10 to 15 years and optimally much more longer, because that is when the true power of compounding really kicks in. So if you want to invest for the short term, there are other momentum hedge funds which can do this for you. But if you want good, solid, long-term compounding in a tax-efficient structure with a very reasonable and fair fee structure, and you want to participate in the growth of the world's fastest growing economy, then definitely consider the Stellar Wealth Partners India Fund.
I think that's a great place to end it. Gautam, where can people go and find more information on the Stellar Wealth Partners India Fund, as well as to follow you on social media, get in contact with you?
So people can contact me on Twitter or LinkedIn. And for more information about the fund, they can visit stellarwealthindia.com.
Gautam, thank you so much for joining me today. I really do appreciate it. Good luck with the launch and everything having to do with it. I definitely will be following closely, and I look forward to our next conversation.
Thank you, Robert.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.